Hello, my friend. I'm glad you're joining me for this video because I want to talk about what I expect to happen for the rest of this year and then some thoughts for 2025. But before we get into that, I want to talk about where we're at year to date. Here it is, the second week of December, and the markets are up nicely. We have the Nasdaq up more than 32%. The S&P 500 is up more than 27%. The Dow Jones is up more than 18%. And most of that growth has been in the area of the large cap, growth stocks, momentum stocks. The other areas have just not performed as well. When we look at commodities, we see that silver is up more than 34% and gold is up about 32% year to date. Natural gas is up more than 23%. But the other areas, the steel, the oil, the agriculture have not done as well. And when we come to fixed income, just about everything is up because the Fed has been bringing rates down. So corporate credit is up across the board and all of the U.S. fixed income is up except for those 20-year plus treasuries. Those are so long dated that they still haven't quite gone back to positive, but they're better than they were. Now, where does that bring us? A lot of people have asked me recently, is the market really kind of over its skis? Has it gone ahead of itself? Should we be expecting some kind of a correction in the near term? And I don't believe that that will happen this year before the end of the year. I think that we're going to still be up through the end of the year, get that Santa rally. Really, the market is agreeing with that. There's a lot of complacency in the market right now. We have a lot of bulls, meaning people that are expecting that the market's going to go up. And the VIX is very low. So that's showing signs of complacency, that we don't have signs of stress, of an expectation of a problem in the near term. And even the high yield corporate bond spread credit is low. So all of that is telling me that we should expect that we'll be up through the end of the year. Now, early next year, that could change because there may need to be some rebalancing done. That could be put off till early next year so that the tax cost of that rebalancing doesn't come this year, it comes next year. And that would then mean that we would have potentially a pullback as a result of this rebalancing early next year. And we really are due a 5 to 10% pullback on a regular basis, so that would make sense. If that happens, I think that will be short-term and short-lived because there's a lot of momentum in the market and there's a lot of reasons that it would continue to go up in the near term. And we'll talk about some of those. For now, the market is pricing in positive reactions to potentially lower taxes going forward, less restrictive restrictions going forward, and even in anticipation that some of the fiscal spending is going to be reined in and we won't have as much of an increase in our government deficit going forward. And so the market is pricing that in positively and expecting that that is going to provide for a better 2025 than had that not happened. Now, as we enter these last weeks of the year, you're going to get or see, you may get it in email, you may see it on social media, or you may hear it on news, a lot of predictions for 2025. Remember that that's a lot of noise because those predictions are just guesses. They're almost never right. 99% of the time, they're not right. So those are interesting if you want to listen to that, but it's noise and it should not drive any of the decisions you make about your own portfolio. What you should be thinking about is what are the things that could play out next year. And I want to talk about 4 P's. Number 1 is productivity. Productivity has been up on an annualized 2.5% basis over each of the last 4 quarters. That's a great thing. That better productivity is going to drive better profits. That's going to drive better growth across the economy. And I think there's some reasons for that. AI is beginning to be incorporated into some of the things that companies are doing, but that we're still in the very early stages of that. So the productivity is coming from more efficient workforces and more efficient supply chains. With the COVID situation, we realized how much our supply chains needed to be improved so that we had a little bit more control over getting goods and services and getting goods when we need them. So we can provide the goods and services that we want to provide here in the U.S. So better supply chains. A second P would be policy. And I talked earlier about some of the positive policy outlooks with the taxes and the regulations and potentially less government spending. But one that would be a negative would be the tariffs. And that's because tariffs would be inflationary. Now, I am seeing that there's some pre-running of the potential for tariffs. So companies are already ordering up or stocking up in some areas so that they are not immediately hit by the tariffs. And if tariffs are enacted, then it would take a little bit longer time for them to have an impact on us here in the U.S. than we might think because of this front running of the potential tariffs. But that said, tariffs are still going to be inflationary because it will mean that we are paying more for the same thing, and that has to flow through all the way to the end consumer. And for that reason, we need to be paying attention to what the Fed's going to do. What actions is the Fed going to take in order to keep our inflation at the level that we need it to be at, not let inflation get out of control again as they did earlier, but also to not have our interest rates here in the U.S. be so restrictive that our small companies and our banks and the like are impacted by this higher interest rate environment. Interest rates are not high as compared to historical highs, but they are much higher than they have been for a good period of time. And that, for that reason, we feel that because a lot of things were decided or priced in based upon very low, almost zero interest rates. And so the difference is felt on balance sheets and cash flows, not just companies, but consumers. So we want to pay close attention to what the Fed does next year. And we certainly do hope that they can continue to navigate this situation without creating a recession. So far, we have avoided a recession. We're having a soft landing, it looks like, but there's still time to go. Now, another P would be profits. And the outlook is that every single sector next year is going to be profitable. That has not happened where every single sector has had a higher profit across the board since 2018. So that would be a positive. Earnings drive profits. Earnings drive the growth in stock values. That's where you have the price earnings ratio. And so if we're going to have better profitability and better earnings going forward, then our prices could go up. Now, the question becomes how much of that is already priced in and how much of that, is still room to run in the prices of the underlying stocks. But that is definitely a positive and could result in decent growth for 2025. Then the last P is protectionism. And around the globe, the attitudes are changing and shifting. And we're moving away globally from the free trade era to a more protectionistic era. And we see that in the conversation within our own country. We see that in other countries as well. And so that's what's driving these tariffs. It's also driving the industrial policy. So these changes would, again, create more of the inflation and could have other knockoff effects. Right now, if you look at all of the investors around the globe, the majority of them have a high allocation to equities, and the majority of them have a high weighting to U.S. stocks. The U.S. stocks have outperformed global stocks for a good long time. And so we have a large percentage, not just in the U.S., but around the globe, that's allocated to U.S. stocks. Now, if that changes and if equities fall back or if people pull back from that allocation, what then? What should you have in your portfolio that would offset or diversify away from the risk of equities coming down? Now, when we look historically, there's a couple of different different ways that equities get impacted. One is when it's growth risks, and something like a tech bubble or COVID or some of those other things impact the growth in the stocks, and that causes the equities to fall. In that situation, the bonds are a very good diversifier. And so it pays to have some bonds in your portfolio. But another time that equities fall is when it's more inflation driven. And in that situation, bonds don't do well. Bonds do not perform well when the Fed is having to fight inflation and raise rates. That's when bonds come down as well. And in that situation, commodities are a better diversifier. So you want to think about having not just equities, but also some bonds and some commodities. And so as we look at 2025, we want to think about these issues and pause and think. Just because we're entering a new year, it doesn't mean that the calculus for your investment portfolio has changed. And just because we're going to have a new administration in government, it still doesn't mean that that calculus for your investment portfolio has changed. What you want to look at is your long-term plan, and then look at your expectations for this year and decide, are there any changes that you need to make? It's a good time to pause, reflect, look at the plan, look at your bucket plan. Do you have the right amount in short-term, mid-term, and long-term? Look at your asset allocation. Are you diversified between stocks, bonds, commodities, real estate? And then make some changes if you need to make sure that your investment portfolio is in line with your plan. And if it's in line with your plan, then stick to your plan, because what you're doing is building long-term wealth and legacy. That's more than just this next year. It's more than just the next 4 years. So stick to your plan so that you're happy with where you're at down the road. That'll keep you on your best path. Thank you for listening.